All right, let's get started. I'll try to bring others in. So tonight I want to completely walk through paper 6 and maybe get a little bit, since we're going to do Zoom sessions in 2 weeks, we're going to lose some classes. So I want to make sure next week you have everything you need for paper 6 and 7. And then what I'll do is I actually have a video. So what I usually do is walk through 6 and 7 in class. But what I'm going to do is create a video that you can watch where I go through creating an entire paper 6 and 7 on the video high level. So you'll have to do a little more work than that. But high level, if you have my investment class, I did something similar there. I'll do it a little more detail here so that you can get on 6 and 7. 6 and 7 is one of the faster papers to write. A lot of it's thinking about your approach and what you're going to do. So that's what I want to do now. Tonight I want to go through what you need for paper 6 and 7, especially for paper 6 tonight, and we'll really focus on paper 7 next week. So as you said last class, for paper 6, you're doing the cost of capital. So we're doing KE. KE was a risk-free rate plus beta times the market risk premium. And so we said last week the risk-free rate, I would just memorize that it's the 10-year treasury. But you have to discuss about what are you going to do with it being so low. I mean, today it's like at 0.7%, just ridiculously low numbers, especially when the 10-year treasury is below inflation. So right now tip yields are negative. So I told you I was going to show you a chart. So let me show you this chart. These are charts you can use in your paper. I'll make them available. I need to update this one though. It's a little bit old. But one thing on the 10-year treasury, the 10-year treasury is a nominal yield. I'm not using the real yield, it's actual nominal yield. And so I believe the 10-year treasury normalized, if you go to normalized approach, it should be somewhere comparable to nominal GDP. There should be some relationship between those two. And Dr. Damodaran, he says the same thing. He ties the 10-year treasury, or he used to, he probably doesn't anymore, but ties it to his expected earnings growth. Just saying there's some relationship between these two. So hearing him say that and hearing other people say that, I just decided to graph it. So here I have US GDP growth in the gold and the 10-year treasury in the blue, and I'm just doing 10-year averages. That's why it's so smooth. If I didn't do 10-year averages, it'd be a lot more bumpy. You can see in the 70s with the high inflation what happened, and then as inflation came down. What I think is interesting is it's really a tale of two worlds. From the 50s, 60s, 70s, and 80s, GDP was always about 1.5% higher than the 10-year treasury yield. So if GDP was 10%, the 10-year treasury is 8.5%. If GDP was 5%, the 10-year treasury was 3.5%. So that's what I used to do for my 10-year treasury to normalize it. I would just say, okay, give me what I expect nominal GDP to be and subtract 1.5%, and there's where the 10-year treasury should be. Now, most of you are looking here at the end and saying, okay, well, there's GDP, 2.5%. That seems about right, but these are nominal numbers. Remember, the numbers they report in the press are real GDP. We've been struggling to get 2.5%, 3% real GDP numbers. So when you add inflation on top of that, GDP should be 4 to 4.5%. We're not coming anywhere close because inflation's low and real GDP is really low. But we'll talk, when we talk about growth rates, we'll get into that a little bit, but especially when we do the implied approach. But what can our economy grow at? And I think, well, we're getting to the 3.5 to 4.5% range. I used to always say 5, but our economy is just not growing very fast. Productivity has been really, really weak. Most major large economies are really struggling. Even China is starting to see their growth starting to slow down, although they've bounced back pretty strongly. But should there be a relationship between the 10-year treasury and GDP? I think absolutely so. But you look at after 1980s, when inflation started coming down, you notice that GDP and the 10-year treasury are almost right on top of each other. So for the next 2 decades, 3 decades, 4 decades almost, the 10-year treasury was right in line with GDP growth. Now, obviously, it's much lower. So maybe we're back to this environment. Maybe when inflation's rising, GDP is above 10-year treasury and inflation is falling, GDP is below inflation. I don't know if that's the number or what. I don't know, I'm not an economist. But that's the normal. You want to normalize it. What should our 10-year treasury be? It certainly shouldn't be 0.7% if we're expecting 1.5% inflation, because it gives you negative real yields, and that doesn't make sense. Why would anyone buy something, lock it in for 10 years when they know it's going to underperform inflation? So that's a number that's tough. You want to do the normalized approach. So remember we said last class, just to rehash, y'all can see my Word. If you're not seeing Word document, let me know. You can do the actual 10-year, and that's where you might use Damodaran to justify that. I'd really encourage y'all, I didn't do this, I was meant to do it, but I've been grading papers all day. Go out and see if Damodaran has done something more recent on that. I'll try to look for it. If anyone finds something more recent from Damodaran, let me know. He's really been the guru on these numbers. What has he been saying recently about, his several years ago when the 10-year treasury really wasn't that low, but he was talking about it being so low. He said, just use the 10-year treasury. So the other one is the normalized approach. A lot of my students do that because that's what I used to do, so they're kind of stuck with what I used to do. That's when I link it to nominal GDP, but you can see that relationship has really fallen apart, especially because of what the Fed's doing. So I think, if you think GDP is going to grow 3.5%, 4%, and then 10 years is going to be 1.5% below that, you're talking about 2.5%, 3% 10-year treasuries. I think we're a long way from a 3% 10-year treasury. And then my favorite approach now is the forward curve. And if you want to use the forward curve, there's videos. I'll have to send you videos. They're very easy to follow. It's very easy to do. So I like the forward curve approach just because I don't have to buy today's 10-year treasury. It seems so low. And I think that's part of the problem. And this is one thing I don't think Damodaran discusses very well. Who am I to challenge him? But this is the risk-free rate. I would not consider buying a 10-year treasury today to be risk-free. If we get any inflation at all, first of all, locking in a negative real return to me doesn't seem risk-free. It seems just crazy, ridiculous. So I don't like that approach. So the forward curve at least tells me what does the bond market think 5 to 10 years from now, so I can at least use that. So there's something there. I'm going to make a note to send y'all the videos. Some of y'all might have used them in my investment class. So you really should learn how to do the forward curve, how to bootstrap the yield curve. So I'll give you a graph. You got a graph for this one if you want to use it. I just don't like that approach anymore because I think it gives you too high a 10-year. I really do think it just gives you too high of a number. It doesn't make sense at all. Why do we use the 10-year and not the 30-year? The 30-year is getting you up to 1.5%, gives you a higher number, but the theory on the 30-year is the 30-year is a very much supply and demand bond. There's not many people that buy the 30-year, so its rate really depends on a lot of asset liability management people that are buying the 30-year for matching purposes, and so it doesn't really fit well. The 10-year is very liquid, very highly purchased. It prices mortgages. It's an extremely important number. So we use the 10-year. I don't like using the short-term rate because it's just so volatile. It's just going to put your valuations all over the place. So I like the 10-year. I just don't like using the current 10-year. All right, let's talk the market risk premium. So make sure you know what the market risk premium is. You will see, and I'm going to show you a document tonight where they call the market risk premium the most important number in finance. It's either called the most important number in finance or the most important number in investing. You'll see that a lot. So it's an extremely important number. It is the number that the average investor needs to cover the risk of investing in stocks in general, not in your particular stock, but in stocks in general. And remember that the risk-free rate and the market risk premium are identical for all companies. You don't have a market risk premium for CVX or for Exxon or for Starbucks. You don't have a risk-free rate for those companies. It's the same number. The only thing that changes is the beta. So the market risk premium, I'm recommending that you use the implied approach. No one emailed me to get the JP Morgan paper, but if y'all want that, I'll still send it to you. I probably should put it out there on Blackboard. I'm going to make a note to do that, even though it's pretty dated. And if any of y'all get a job at JP Morgan and you can ask for their updated numbers and send it to me, that'd be great. So the implied approach, we're going to say the required return on stocks equals the expected return on stocks. We talked about that last week. And so, you know, given that the required equals the expected, and the fact, sorry, someone's Skyping me. It's probably a scam call too, because I don't know who that is. Anyway, lost my train of thought there. So we talked last week about the required equal and the expected. We can't get the required return because it's a theoretical number, but we can get the expected return, and we're going to say the expected return on stocks equals the current dividend yield plus expected earnings growth. And then we're going to say, we're going to add one last thing to it, and this is really going to help us, I think, plus stock repurchases. I'll show you that tonight as well, plus expected growth. So stock repurchase is a new thing to add. It used not to be part of the equation, but it is now. So we said the current dividend yield, I already showed you that. You can just use the current yield on SPY and you've got it if it's there. Yahoo Finance every once in a while takes that number away. I don't know why, but it's there right now. Last time we checked, it's there. We'll talk about stock repurchase, but let's do expected earnings growth. But before we do that, let me show you a couple of charts again that you can use in your actual paper. So these charts are fine. I'll try to update them. So there's a few charts here. The first one is, let me show you this one. What this one shows you is, I've always heard that the stock should give you the current dividend yield plus earnings growth. That should be what the stock market provides you. And so I thought, well, is that what it actually has given us historically? So I created this chart. I really like this chart. I use it all the time. I went decade by decade, and the red line is the dividend yield for that decade and the earnings growth for that decade. And the blue line is the actual return of the stock market. And I didn't start them right together. I went back to 1871. I assumed that the stock market was in 1871. I don't know why I thought that, but it just made my line look better. And you can see going along, they track pretty closely, and you get the roaring 20s, where the stock market was definitely overpriced. Then you get the big crash in the early 30s, where the stock market went too low. Some of you probably wondering, how in the world could this line be going up in the 30s and the 40s and the Great Depression? And it's true that the S&P 500 dropped dramatically during the Great Depression, but you do it on an annualized basis, it wasn't that bad compared to the dividend yield. The dividend yield back then was like 4, 5, 6%. So they had such a large dividend yield that offset the large drop in earnings growth. And so the stock market actually had a positive growth. When you take dividend yield, which is huge, and add the negative earnings growth, you actually still came up with a positive number. Then you came out of the Great Depression and you had a strong growth there. 60s and 70s, you had a little bit of jump in the 70s because of inflation. And the stock market's been trailing that really well until the dot-com bust. The dot-com bust didn't bust all the way back down the line. Then we had a 2008 crisis. You can see in 2008, first time in about 20 years that the blue line came back to the red line. Since that time, we've been way above. If I updated this, you would see the impact of COVID-19, but I don't think we came back to the red line because of COVID-19. It was a sharp decline, but it didn't come down all the way back down the line. So I think you can make a strong argument that definitely stocks do give a return of dividend yield plus earnings growth. The reason recently it hasn't been doing that could be one or two reasons. It could be that the stock market is grossly overvalued, and there are people who believe that. But the second thing could be that risk is lower now than it's been in the past. We have a lot more information. We have a Fed that's much more accommodating. We have globalization. There's a lot of things that make the world a lot less risky. A lot of you don't think that the world seems more risky today, but I grew up in the 60s and 70s when it was a disaster every year. So the world does seem safer now. We don't have the Cold War and the Soviet Union and people pointing bombs at each other in the same extent we had back then, and assassinations and all those kind of things. So the world seems less risky. If that's the case, that just means the risk premium has come down, and that's going to give you a one-time bump to the stock market, which means going forward, the stock market will just go parallel to this red line. Doesn't mean that it's overvalued. It just means we had a one-time adjustment, lower risk premium. And that's possible. There are people who do think the risk premium is lower today than it was back in the 50s and 60s when you only got information in paper and only once a quarter. Today, you have at your fingertips all kinds of data that you can, it's a lot of information. So risk should be lower today. Granted, globalization does create new risk, as we're seeing with COVID and with other things going on, but we haven't had a major world war in quite some time. Vietnam War was the last really major one. So the world's been safer. Crime rates are down. There's a lot of things that say that the world's just not as risky today. So this chart supports my argument, even though we're a little bit high today. And then the other thing I'm arguing is that corporate earnings growth for the entire stock market should have some relationship to economic growth in the United States. And so this is a chart you can use for that. Again, if I can update it, I will. I usually wait till the last second to update these so I can get the latest data. I'm not real sure on this one if I want to update it, because actually I think I did update this one, and I updated it without second quarter, because second quarter really distorted everything. We'd never seen GDP drop like that before. But anyway, what this chart does is the red is the actual earnings growth of the S&P 500. You can definitely see 2008, and we bounced back from that pretty strong. The blue line, the green line is the actual growth in our economy. And you can see our economy actually grows faster than earnings growth. Some students are really surprised by that. But corporate earnings as a percentage of our economy is pretty constant, usually around 13, 14%. Doesn't really change all that dramatically. And so if you think our economy historically has grown 6%, again, nominal, that would be a really high number going forward. We're lucky to get 4%, 4.5% going forward. Our economy's grown 6.4% and corporate earnings have grown 6% since back to 1950. So you see our economy's grown slightly faster than the corporate earnings growth. And so I'm going to tie my expected earnings growth to my expectations for the economy. All right. So let me go back to the word. So expected earnings growth is going to be a function of nominal economic growth. And the reason I do that is economic growth is pretty easy to forecast. Expected economic growth is simply a function of productivity, labor growth, and inflation. So here's another chart I can give you, but that's it. I don't have imports in there. I know it's been a strange year where I think we just hit a record deficit this last quarter, but the quarter before we had like a really small deficit, trade deficit. So import and exports, obviously that takes some of the numbers off, but it's not as large as you would think. It doesn't have as big of an impact as you might think. Even listening to our two presidential candidates, it's not as huge as you might assume from the debates. So this is a chart you can definitely use in paper 6, where I just show you what those three components have been the last several decades: productivity, labor growth, and inflation. And you can see the productivity growth has averaged a little under 2% in the United States for the last 7 decades, a little under 2%. It's been really weak the last 10 years, 2010 through 2019. People don't understand why that's the case, given the internet and AI and robotics and all these kind of things that are hitting. Why isn't our productivity higher? So there's some debate if that number is even accurate. Make sure you know the definition of productivity. It's a really simple ratio. All the Fed does is they take real GDP growth, how much the real GDP growth, and they subtract from that hours worked growth. So if our economy went up 3%, but we increased our hours worked by 2%, then our GDP was 1%. It's a really easy number that they do. Now, I don't know how they get hours worked, but somehow they get hours worked, and that shows our productivity. So productivity is pretty strong in the 2000s and the 1990s. So we had 2 decades in a row over 2% after some pretty weak productivity numbers in the 70s and 80s. Obviously, coming out of the war years, you had really strong productivity in the 60s. The 90s might be, when I graduated from college, not in 1920, but in 1986, when I graduated from college, the department I started with, we had just gotten our first personal computer, and all 8 of us got to share one. And we had a dot matrix. So you can imagine a productivity from that. There's stuff that I do in my classes that if I tried to do that in 1986, it would have taken me months. And I can now do them in my classes in under 10 seconds. I mean, or under a minute. So it's amazing. We've had some of that productivity, but why is this last decade been so weak? As I tell students, I read The Economist every week, and President Obama had a article in The Economist at the very end of his term, and that was one of the things he brought up. Why is productivity so low? And he was talking about education and immigration and those kind of things. I mean, there are certainly things that impact it. I do think public education is a big part of it. I do think public education is about 40 years behind. I think even university education's behind when it comes to productivity, getting y'all so you can actually produce more. We're kind of old school in how we do things. So I do think COVID-19 may actually fix some of those things. I think COVID-19 is actually making us more productive. I still have groups that want to have meetings, and like, you want me to drive 30 minutes to a meeting and drive 30 minutes home for a 45-minute meeting? Let's just Zoom the thing. Why are we driving all over the city to have a meeting? So we'll see people working from home, those kind of things, making us more productive so we're not sitting in traffic. We'll see if we see that impact in the next several years. It'll be interesting to see what productivity numbers do the next couple of years. But my case I'm going to make is productivity 2 to 3% is going to be somewhat the upper end of your max, of your range of what you would use. Our best decade ever was a little below 3%. I think 2% would be a stretch. We got there in the 90s and 2000. There are things, definitely autonomous vehicles, nanotechnology, AI is supposed to do stuff. I don't think 5G is going to be big productivity. 5G might be an anti-productivity because we'll all be watching movies on our iPhones. But so I'm not sure what's going to necessarily drive productivity. Energy could be, battery technology, electronic vehicles. There are things out there that could have a big impact. But so far, we're not seeing them at all. But that gives you a good basis for productivity. Let's say 2%, maybe 3% at the upper end. Then you look at labor growth, and you look back in the 2000s, our first decade ever, where we actually had fewer people working at the end of the decade than we did at the beginning of the decade. A lot of that's because of banking and construction, home construction. A lot of people were laid off in 08 and 09. We'll see what COVID has to do with that. These numbers are going to get really tough because there's a lot of people we know that aren't working, but they're classifying themselves as furloughed, and we know they don't have a job. So it's going to take a few months for that noise to clear out, know exactly what we have. So it will be interesting. That's one of the reasons I left COVID-19 out of these numbers. It just so distorts it. So what do you think about labor growth? Well, you got the baby boomers retiring. You got immigration. That's a serious political issue. Some of y'all talked about the shortage of skilled labor in your paper 1. You might talk about it again in your paper 3. Labor growth is an issue. There's a lot of forces against it. Maybe the one advantage with baby boomers is a lot of them are not ready to retire, so they'll just keep working. You're hoping they retire so you can take their jobs. But labor growth, boy, I don't know if you could argue anything much more than 0.5%. 1% would be an extreme on the high end. And then inflation, you know, the Fed says they're targeting 2%. That sounds good enough to me. So you can definitely use this chart, put it into your paper. And so, you know, if you put the pieces together, you're talking about, let's say 2% productivity. I'll go 1% labor growth. I don't believe that number. And 2% inflation. So we're talking about a nominal GDP of 5% and real of 3%. We haven't been able to hit 3% in quite some time. I thought it was funny on Facebook. I had these people comparing the current president to the prior president and showing a 4.2% GDP versus whatever. And I had to point out to them that 4.2 was the initial GDP number that got adjusted down to 3.2. So they were somewhat exaggerating their own president. These numbers get adjusted a lot, and we've had a tough time getting a GDP number. Even, you know, I think Trump said he was going to get a 4%. Now he's pushing back to 3%, and he's struggling to get 2.5. 2.5, you know, is about what the average has been under Obama and Obama's second term, and under Trump's first term, or only term. We'll see in a few months. So, you know, 3, I think, is a high number for real GDP. I don't know many economists who are confident we can get 3. So 3, and I think it's on the upper end because productivity's been so weak and labor growth has been non-existent if you add the last 20 years together. I'm pretty confident the 2% inflation seems like a decent number, but you're talking about a 5% number. Now, if you think about that back to the 10-year Treasury, a 5% GDP implies a 10-year Treasury at 3.5%. So it's the bond market certainly doesn't believe our economy is going to grow that fast. The 10-year Treasury would be well above 2.5%, 3% if they really believed our economy is going to grow that much. I know you can see the Fed's doing things to keep that rate down, but still, the Fed's not buying every single Treasury out there. Someone's buying these things at yields of below 1%. That implies nominal GDP, not real GDP, nominal GDP in the 2 to 3% range. And I'm talking about a real GDP of 3%. So it's a pretty aggressive number. So the current dividend yield, let's say the dividend yield, let's be aggressive on that, and let's say 2%. I know it's much less than 2%. So what are we left with? That gives you an expected return on stocks of 7%. If you use that in papers 6 and 7, you're going to get some really bad valuations. I can just tell you that now, unless your beta is really high. So what can save us? And here's the one thing that might save us is stock repurchases. All right. So what I'm telling you here, you can use exactly what I'm talking about here in your paper, but you got to put it into your own words. All right. You can look at student papers. You'll see a lot of this in the student example papers. You just kind of come with your own rationale. I'm going to give you a document tonight that will give you some words, even though it's a little bit dated, to give you some words that can help you with that. So let's talk about stock repurchases, and then I'll open up the questions so I can make sure everybody's with me. And where is it? Okay, I've got the document out there. Where is what? All right. Let's see. What don't I have? Just a second. I've never understood why it doesn't show me everything I have. Let me. Okay, I guess. Can y'all see this article highlighted with a graph? Can someone say yes?
Yes.
Okay.
Yes.
I guess with a PDF, I can switch files on the PDF, so that's good. All right, I guess it's like going to Excel. All right, sorry about that. My first time to use PDF on Zoom. All right, so this is a great chart right here. For most of the time, up until really most of the 90s, we ignored buybacks. And the reason for that is most companies issued more stock than they purchased back. So it was actually a net negative. Most firms actually were getting more cash in than were sending cash out. But if you look in the last 15, 20 years, you see this green line and this blue line, you see that the buyback yield has actually gone above the dividend yield. Companies are actually sending out more money to buy their stock back than they are to pay dividends. That's probably changed this year in 2020 because of COVID-19. Firms are probably trying to keep their dividends going, but are probably cut back on stock buybacks. And so that gives you the yield on stocks. They have some tables that show you these numbers. Further down here. So the dividend yield and the total payout growth, you can kind of look at each one of those and just see where the growth is coming from. There's another table further down, just a second. It's a kind of a long paper. Actually, I'd encourage y'all to read this paper because it's a really quite eye-opening paper, but I don't want to go through all of it. You can actually read just my highlights if you'd like to. So, so you can see the payout yield, dividends versus total payout. So look back to 1871 through 2014. Dividend yield was 4.5%. The payout yield was 4.89. So stock buybacks added almost nothing to that yield, only 0.39%. That's why we ignored it. But if you look at the current, the dividend yield is 192, and the total payout's 321, which means like the stock repurchase is like 1.3, 1.4%. So it has had an impact. So I think that's the table I actually like using the most. So you can see that the growth in total payouts is greater than the growth in dividends. And its impact on the real return is quite significant. So you can see here, it's not just what the yield is, but it's also the expected growth and what impact that's going to have. So we're talking about earnings growth, but if stock buybacks growth is bigger, you can get a little bit more added in there. But essentially, this is what he's saying is there's about a 1.5% that you need to add. So he's taking a dividend model versus a total payout model, and that difference is about 1.48%. So if I go back to the word, now you're making an assumption that this is going to continue. When you have firms like Google and Facebook, probably Apple as well, with all this cash, huge cash, even though they may only be 15, 20% of the market, they have so much free cash flow that buying back stocks, they're going to essentially dwarf that number for everybody else. So you're talking here in the 1 to 1.5% range. I think I'll use 1%, but you can use that document. You can certainly say 1.5, but your dividend yield might only be 1.6. So let's say between dividend yield and stock repurchases, we have something in the 3% range. That's real similar to what they're showing. Of the combined, they have a 3.21%. So 3% of the two combined makes sense. So when you bring all this together, what's your expected return on stocks? You get 2% plus 1%. That gives you the buyback and the dividends. Plus 2% plus 1% plus 2%. That's productivity plus labor growth plus inflation. That gives you an expected return on stocks of 8%. My opinion, you might strongly disagree with me on this, but anything in the 6 to 9% range is justifiable, and 6.5 or, well, I'll leave it there. You know, I might not quite go up to 9%. I might not go down to 6%. 7 to 8 to me seems the most reasonable. That's much lower than what we've had historically. Historically, that's been 10 to 11%. But a couple of things are going on. Our economy is growing much slower now, much more slowly now. Dividend yields are much lower, and even though you bring in the stock repurchases, even with the stock repurchases, that 3% dividend yield plus stock repurchases is much lower than what we've gotten in the past. We've gotten dividend yields have been more in the 4 to 5% range. So that lower dividend yield probably takes 1 to 2% off expected stock returns, and lower GDP growth probably takes another 1% off. So if we've gotten 10% historically, 10 to 11% historically, you can expect stock earnings, stock returns to be about 7 to 8%. All right, so what do you do with this? So if the stock expected return, let's just say is 8%, and let's say the risk-free rate is, if we normalize it, maybe we get 1.5%, then what is our market risk premium? You should have had this at least 3 different classes now. You just take 8% minus 1.5%, and you get 6.5%. All right. Market risk premiums, they can certainly be in that range. There's an article by Damodaran that I gave you that definitely gets you into that analysis. It's another article I need to update. But let me show it to you because it's really quite eye-opening, even though it's incredibly old. So this is another article we got to find an update for Damodaran.
Would the lower like stock market return also be like because, like you said, the world's getting more stable?
Yeah, so that risk premium is really high, but it's really high because the risk-free rate's so low. So we have a problem. You know, this is something I wish. Well, I'd love to have a public debate with Damodaran. He would destroy me, no doubt. But there's questions that he doesn't answer. So he also says that the risk premium is really, really high because the risk-free rate's so low. But he's saying that at a time when the volatility index is unusually low. I don't know how you can say the market has a very high risk premium when the insurance they buy on the stock market, options, has a very low risk premium. Doesn't make sense to me. I don't know how to reconcile those two things. So we've got some stuff that you just can't reconcile them. It's just there is no obvious answer. Now here's Damodaran's. This is old. This is almost 8 years. This is 8 years old, so it's pretty old. But what I like in here is this graph he has. I didn't put it in this one. Oh, well, okay, sorry. He has another paper. Boy, I thought it was this one, but he has a more up-to-date one. Sorry, a former student's calling me that I don't need to talk to you right now. So anyway, he has one where he shows, Alan, the expected return on stocks, and it goes right around about 8% the whole way across. And then you see the risk-free rate going up and down. And he just shows his market risk premium going like an accordion all over the place. But if you graph that against the volatility index, there's no relationship between those two things. And that doesn't make sense to me. Same thing with corporate credit spreads. If the market really is worried about risk and they have a high risk premium, you should see corporate bond spreads at historically high levels, and you don't. I know COVID-19's messed stuff up, but before COVID-19, corporate bond spreads were at really low levels. The VIX was at really low levels, and yet you're using a market risk premium that's extremely high. 6.5% is at the upper end of that. So he does not address that in here, and I don't, you know. Someone said they found a new article of him on the risk premium, and I should go out there and find it. I always start the semester thinking I'm going to do that, and then I just I'm going to write a note to do that as well. It's better if y'all find it though, then you get the practice of finding these things. He's got blogs linked over here, so maybe in there somewhere he's talking about their equity risk premium. So
would that mean that that the stock market's undervalued?
Well, if you think real risk premium is 4%, So you're thinking people would be perfectly fine with a 5.5% return on stocks because the risk-free rate's so low that 5.5%, you know, historically we've made 10, but hey, if I can get stocks making me 5.5%, I'd be happy. That doesn't seem right. I don't know many people who say they'd be happy with a 5.5% return on stocks. So I don't know. You have to think through this. This is all theoretical stuff that has been destroyed by the Federal Reserve. Keeping rates so low for so long. All of the theories that worked pretty well in the 50s, 60s, 70s, 80s, 90s, and 2000s aren't working. It's hard to theoretically get all this to work. You don't have to resolve this in your paper, although I'd love to see you try and give me some insights on what you're seeing. I've never heard Damodaran explain how the risk premium can be unusually high and the VIX be low. So, you know, Alan, you'd be making the argument that the required return is much lower than the expected return, but investors just haven't recognized it yet for some reason. That's a hard one to say either why that's the case. So yeah, I don't know. Those are all good questions. These theories, you know, remember what they said about capital asset pricing model. I think Damodaran said this. It's the worst theory, except for all the others. It's terrible, but it's the only thing we got. We don't have anything better to replace it with. You will see this on the CFA exam. They still test the CAPM quite heavily, especially on part 1. In fact, I think the reason I had no trouble passing part 1 is they had about 10% of the exam was just basic CAPM questions, just plugging in numbers, real simple stuff. So they still test it quite heavily. It's still used. I do see firms that use CAPM quite a bit. You have to have some discount rate. Now, I saw one firm I interviewed. I forget the name, Marvista or something like that. They said, we just use 10% for every stock. I thought, that's great. You're using 10% to value Walmart and 10% to value United Airlines. That makes no sense to me at all. Walmart's a far safer company than United Airlines. So that to me just was ridiculous. But so you can't just use the same discount rate for every stock. We know they're not all equally risky. But anyway, this gets us the 2 numbers. So any questions on this? If you read the example papers, you'll be seeing this approach over and over again. If you did the paper in my investment class, you did this. I don't want you to run scenarios on these 2 numbers. I only want you running scenarios on the beta. And the reason you don't run scenarios on the risk-free rate and the market risk premium is you're trying to figure out if your company is relatively overvalued or undervalued. And since the risk-free rate and market risk premium are the same for all companies, they wash out. They don't matter. So really, it's your beta that determines this, the most important one. So I don't want you running scenarios on those 2 other inputs. So now you've seen the entire paper 6 other than the beta. We'll talk about beta next. Any questions? Y'all understand the stock repurchases? You understand the graphs, right? I gave you a graph that shows you. So here you have a graph for that. You have a graph for that. So I've given you some graphs. I even gave you a graph for this one. Not many students put that top one in their paper. But yeah, you have graphs that you can actually use. If I get a more updated one, I'll put it out there. So what I'm looking for here is that you can logically put on paper how to come up with the discount rate to value a stock. And that seems like such a basic thing every finance major can do. But when I did interviews, many interviews, I would say probably over 50% of college finance majors, undergraduate, could not come up with a discount rate for a company. Now, if I gave them the risk-free rate, I gave them the market risk premium, and I gave them the beta, most of them could do it. But how many of your bosses are going to give you those 3 numbers? The answer is 0. So I love what we do in finance undergraduate. We give you all the hard numbers, and then you graduate, you start your job, and suddenly you've got to come up with those numbers. So I'm going to force you to come up with your own numbers. All right? I'm not going to give you these 3 numbers. You've got to come up with them yourselves. I'm giving you a range, and the reason I'm giving you this range is not so because I want to indoctrinate you. I'm giving you this range because I know these range will work well when you value your stock. Because what I don't want you to do is do all the work on paper 6, and you come up with a discount rate of 4.3%, and then you get to paper 7 and nothing works. So I'm giving you numbers that I know will work in paper 7, so I'm trying to save you some headache there, so that you can get crazy, crazy evaluations in paper 8. All right, no questions on that? So what do we have left? We have beta, and you're going to forecast your beta, and you're going to do a base, a high, and a low. So this is in the class notes, but I'm going to summarize it here, because you should be taking notes or typing notes, because if all you do is read it in the class notes, it's not going to stick with you. So on the beta forecast, you need to have a section that talks about the type of company you have. All right, you want to spend a few paragraphs on the type of company you have. You have 3 choices: defensive, cyclical, or in between. All right, so this is where you're going to assess the business. What is their business? Here you're focusing on their revenues and their sensitivity to the economy. So hopefully you have some idea what a defensive company is. So you got a low beta defensive company. What are we talking about there? Your grocery stores, which we don't have any of. Grocery. Discount stores. So we do have some of you doing Costco. That definitely fits in there. Energy, I'm gonna wait for energy more on the in between. No one's doing utilities, but utilities would fit in there. Some healthcare would fit in there. So these are these things that you're going to buy no matter what the economy is doing. So we refer to them as consumer staples. Most of them are consumer on the low beta side. Certainly, if you got a company that develops and searches for gold and actually produces gold, that would be a low beta company, because gold does well during crises. So there are some non-consumers that would be low beta. There's not many. Most non-consumers are higher. So there's your low beta defensive companies. Looking at your list of stocks, see if I can find it. Your list of stocks. Ecolab, Richard? I don't know on that one. Chemicals are usually high beta, but you may have to think about that one. We'll talk about how you can somewhat assess that. What about Netflix? If people are worried about losing their jobs, are they going to cancel Netflix or cancel their Starbucks coffee? Which is more important to them? You know,
Netflix is more important.
Which one?
Netflix is more defensive.
Yeah, I mean, sometimes we assume a firm like Netflix is cyclical because people are losing their job. But a lot of people are losing their job. You know, Netflix is only what, $10 a month. At least you got something you can do while you're waiting for a job. Costco's definitely. General Mills. So Hunter, definitely General Mills is a low beta. Procter & Gamble, Max, definitely Procter & Gamble is low beta. Coca-Cola might be low beta. Constellation, what do y'all think? Constellation. Alcohol. What do people do when they're worried about losing their jobs?
Low beta, they drink more.
That probably is a low beta. Pepsi and Coca-Cola are probably low betas. Most of the rest of you have kind of in between or high beta type of companies, but some people argue that Apple's becoming more of a commodity, but it's when you're selling a $1,200 phone, I don't think you can call that a low beta company. So those are your low beta. Your high beta, cyclical. So all your durable goods. So CarMax, Whirlpool, those are definitely high beta. Your manufacturing. So You know, we have someone doing Deere. So Adrian doing Deere, Whirlpool, definitely. Delta Airlines, obviously. CarMax, ATVI, Curtis. I don't know, Curtis. That's an interesting one. We got all these unemployed blue-collar men that are spending all their time playing video games. Maybe they would give up Netflix and alcohol before they give up video games. I don't know. Nike, Lululemon are considered high beta firms. Oh, I forgot on the low beta. So we got Nikolai and Valerie and Lewis. You can certainly make a case that a Lockheed Martin is a low beta company. Whenever we go into a recession, the government usually doesn't cut back on its spending. In fact, it might actually spend more on defense in order to keep spending out there. So I would guess Lockheed would probably be a low beta. But Lululemon, Nike, those are high beta companies, definitely. Starbucks, I would consider Starbucks to me is kind of an in-between. So I'll leave that to later. NVIDIA, Texas Instruments, I consider those high beta companies. You might be able to make an argument on the other side, but you would generally think of them as high beta companies. So most of your companies, I think, are cyclical, higher beta. So durable goods and leisure, those are definitely going to be your high beta companies. And then in between, you know, fast food. I think of fast food. McDonald's to me is somewhat of a round one beta. Kind of the higher end discount stores, maybe a Home Depot. Well, Home Depot and Lowe's are probably high beta because they're tied to the housing market. But I can't remember the name of the store. Kohl's, maybe a Kohl's or a Target. You know, they're not quite discount stores like Walmart, but they're still cheaper places. So I might think of a Target being closer in that 1.10 range, not being really high.
What would like Amazon be?
Well, Amazon is, most of their income has been driven by the cloud side. You would usually think of that as a high beta company, but it's getting tougher. Some of these things we think about as high beta because they're technology driven, maybe becoming lower beta because they're absolutely required. You have no choice but to do them. You know, Amazon. How much of Amazon is supporting Netflix? You know, if you think Netflix is low beta, then maybe Amazon's low beta because that's a big chunk of their cloud, their storage. So I don't know. We'll see, right? We get to step 4. Step 4 is the history. We'll look at the history. So you might look at history and might actually change your opinion about your company. So there are some companies you could argue either way. I'm okay with that. If you argue that Ford is a low beta stock, I would have a tough time buying that. But it has had a low beta just from a regression standpoint. But I would not buy that. If you want to argue that Walmart's a high beta stock, I'd have a tough time buying that. There's some that just don't seem right to me. To say that Coca-Cola is a 1.8 beta company, that just seems really wrong to me.
Professor. So you're saying low beta and high beta. On the low beta side, are you looking under 1 or closer to 1 than?
Well, by low beta, I mean less than 1, but you know,
close to
grocery store, you can get down to 0.4 on a grocery store. Discount store, you know, and they tend to be 0.4 to 0.6. Discount stores, you're probably in the 0.6 to 0.9 range. Utilities, you're probably in the 0.6 range. Healthcare it kind of depends. The problem with healthcare is so much healthcare is provided by employers. And so when people lose their job, they lose their healthcare. So you might be in the more in a 0.9. But we're definitely talking less than 1.
Okay.
I would not use any betas below 0.4, really not even 0.5. And you'll see why in paper 7 you don't want to do that. So I'd be real cautious getting too far below 0.6, 0.5. I don't think any of the stocks in our list is a 0.5. I don't think Costco is a 0.5. I think Costco is probably more 0.7, 0.8 because of their higher leverage. So I don't think any are that far down. On here, now we're talking on the durable goods like a 1.5. Manufacturing could be 1.4 to 2.5. I would not go much higher than 2.5 on my betas. That's getting pretty high up there. The only reason you go to 2.5 is because your firm has a tremendous amount of debt. That's the main argument for a really high beta. It's a manufacturing firm with a lot of debt. So if Deere had a lot of debt, I might push them up above 2. Otherwise, I generally wouldn't.
And why would you do that? Why would you do that? Because they have higher debt.
Well, debt drives up beta. The higher debt you have, the higher beta. We're going to talk about that maybe next class. But
okay,
yeah. So there's two things so this tells you what ballpark you're in on beta, the type of company it is, and then you're going to adjust that up or down depending on their operating leverage and financial leverage. That's the next two pieces of this. All right. So we'll do that next. Fast food, energy can be an in-between. People tend to buy gasoline. I know energy's done horribly this last recession, but that's because it was right in the eye of the storm. And it did horribly in 2008 as well. But firms like Valero and Exxon, Chevron, they can in normal recessions do okay because people don't cut back on driving as much as they cut back on other things. This time, because people just stopped going to work, they cut back on driving dramatically, so it had a huge impact. There are some financial services. We're not doing financial services. I would put close to 1. Right now, I put financial services higher because of what's going on. But one area of financial services I think is interesting are the payment services. So the PayPals, the MasterCard, those kind of things. Someone was asking about Amazon. If Amazon's beta is coming down, then MasterCard, Visas, and PayPal's their beta is coming down. Those firms are just amazing how well they do all the time. I'm hoping someone comes in and disrupts them and radically changes that industry because I think they're all grossly overpriced for what they do, which is why they're so ridiculously profitable. So you might argue those somewhat in the middle. They're becoming, we're starting to buy everything like that. And if we cut back on shopping, then definitely that's going to hit them. But we'll continue to buy staples, and we put our staples on credit cards. So they have somewhat of a protection there. So I don't think, and we'll see when we look at historical numbers, we'll see what's going on. So let me look at your list of stocks again. Let's just see. So aerospace, if it's heavy defense, you can definitely argue low beta there. Energy, you're probably somewhere in the 0.9 to 1.2 range. Apparel, you're definitely in the 1.3 to 1.5 range, so Lululemon and Nike. FedEx, we usually think about FedEx as being a high beta company. It's getting tougher on some of these companies because we're getting more and more stuff delivered to our houses. So now that we're having staples delivered to our houses, that may be coming down. I think FedEx is still a higher beta company, Alejandro, because FedEx tends to ship more expensive stuff. They're not really shipping food as much. PayPal, we just talked about that. Ecolab, I'm going to be interested, Richard, I want you to come up on that. You have consumer discretionary and manufacturing. Obviously, all of those companies are high beta. Shamir, Delta, you could probably push Delta above 2. And consumer staples, obviously, all of those are going to be lower. And then...
Real quick question, Professor.
Uh-huh.
You said that Ford has had like a low beta for a while. And I was
just for a short period of time on Yahoo Finance, it was like 0.65. But it's back up to a more normal level now.
Okay.
That's just pure, the betas they show on Yahoo Finance is just the last 3 years monthly. And betas can get really distorted by just one unusual month. So I don't trust Yahoo Finance to get my betas, and we're going to show how we did it. Adobe, 3 of y'all doing Adobe. Adobe's kind of interesting. You would think of Adobe as being a 1.3, 1.4 beta normally. It's a tech stock. But it's also something that people in those fields, they have to have it. They have no choice. Kind of like Oracle, right? Oracle has software that businesses have to buy, and they may be cutting back on their employees, but they're using Oracle just as much as they always have. Some firm that does a lot of desktop publishing, they may be cutting back on employees, but they're probably using Adobe about as much. Maybe they cut back on some of their subscriptions. But you know, some of these are getting a little tougher to call. I think of Starbucks as at around 1. BJ Restaurants, Ricky, well, we don't have that stock anymore. Starbucks, it's expensive, but a lot of people are going to buy Starbucks no matter what's going on. But I don't think a Starbucks is a 1.5. It might be a 1.1 type of company. But that's the kind of analysis you got to do and figure out for your company what you're going to use for your company. But you'll see when we get to step 4 whether or not you like that answer or not. All right, so that's the first thing you got to do. You're going to spend a few paragraphs talking about them. Now, some students will actually even do a regression of their revenues to GDP. I don't recommend that because there's so much noise in the accounting data, but if you're just curious, you want to say, especially if a company that has 20 years of data, you just want to see what do their revenues do when GDP drops. I still think you're going to find it's a little frustrating. Obviously, if you're doing home construction nosedives when the economy dives. That would be pretty straightforward. But you think about a Walmart. Walmart did extremely well in 2008. They've done extremely well this year under COVID. So normal recessions, shopping at Walmart, it drops a little bit, but not nearly as much as it drops at other companies. So they're somewhat protected and defensive. They usually have to cut their margins somewhat to keep customers coming. So they're not immune to recessions, but they do a lot better than the average company. Costco might even be a lower beta than Walmart because Costco, they're even cheaper. So people, when they're really struggling, they're gonna go to Costco and buy 80 gallons of something and eat it over the next year, just because they're trying to save money. So but there's still, Costco does sell flat screen TVs. They do sell some apparel. There's some stuff Costco sells that will definitely be cut back on. So they're going to be hurt some. So, but you could try that. I don't usually think of it as that way, but you could try it. It's interesting to try it. It's not that hard to do it because it's easy to get quarterly revenues and it's easy to get quarterly GDP numbers. All right, step 2 is the operating leverage. Operating leverage, we're looking at the degree of fixed cost, the cost structure. And here, what you want to do, you want to do 2 things here. One thing you want to do, you want to have a subjective discussion about your company. Just think about the cost structure of your company and think about, how much fixed cost there is. Where do fixed costs come from? Well, if you have salaried employees, that's a fixed cost. If you have unions, that's a fixed cost. If you have a lot of property, plant, and equipment, that's a fixed cost. If you have a lot of R&D or a lot of marketing, that's a fixed cost. So Nike and Lululemon, if there's a heavy marketing budget, that's a fixed cost. So that's the kind of things you're looking for your company. You can also think about the cost of goods sold and elasticity. We talked about that some last class. So those are the kind of things that you're looking for there. So that's a subjective discussion. Think about your firm, really get into it. The second thing you're going to do is I'm going to give you an Excel file that you can calculate the standard deviation margins. And this is my theory that firms with high fixed costs have volatile margins. All right, boy, we're running out of time. All right, so next week I'll show you this spreadsheet, and the next one after that is financial leverage. That one's the easiest part. You can usually handle that in a couple of paragraphs easily with the chart. So that one's really straightforward. So Joseph, to your question here, higher debt means higher beta. Just really straightforward. Not only is that, but there's actually a formula for it. We're not using that formula in this class. You might have had it in 3013 or another class. It's a real simple formula. We're not going to actually use it. I just want you to subjectively do that analysis. And then the last thing you're going to do is the history. So those are the 4 things you need to do. We'll finish up the first part of next class. We'll finish up these 3. I'll show you how to do these. And then you'll have a video that goes through them all again, all together in one place. You do have to do the history. And what the history will do is it will confirm or reject your assumptions from above. So that's one thing it's going to do. If you say, wow, this is a really high beta stock, and you look at its historical, we're actually going to do a historical rolling beta. You look at his historical rolling beta, and it's never, hardly ever been above 1.4, and its average is like 1.1. That may make you pull off of your 1.5 assumption. The second thing it's going to do is it's going to give you your scenarios. Your base, high, and low. So, and I'm going to say we're going to do the rolling beta, and we're going to do it with the median, the 90th percentile, and 10th percentile, and that will probably help you get those scenarios. Is what's the highest my beta could be, what's the lowest it could be. And remember, your high bet case is your lowest beta because it's going to be your highest price, and your low case is your highest beta. And once you do that, you plug into CAPM, and paper 6 is done. There's your paper 6. That's your entire paper 6. So I'm kind of writing paper 6 for you. It's just that you've got to come up with your own assumptions. I did want to show you, let me real quickly, I want to show you a document I put out there for you that you can certainly use. It's a Barclays article. I think I showed you all some of this last time. If you have some time to read through it at a high level, they're using exactly the model I'm using. This is for the market risk premium. And here's their formula right here. I don't know if you can see that formula, but we just did this formula. I don't know if it looks familiar to you, but let's see if you recognize it. So D over P, what is that? That's your dividend yield, right? We're getting, the R is the expected return on stocks. Dividend yield, what do you think the minus change in S is? Any guesses on that?
Is it the change in sales?
No, it's not sales. The S here is stock. So this is actually your stock repurchases. So this is the first 2 things I just showed you, right? Dividend yield plus stock repurchases. And then what do we add here? I is inflation. G is real earnings growth. I combine these 2 for earnings growth. Remember, I said dividend yield plus earnings growth. I combine those 2. The last one, repricing, you're going to completely ignore because that one is so subjective. Actually, I disagree with how this article works. I wish I could debate these guys in public because I think they made a mistake in their analysis, but we're going to ignore that. We're going to assume the stock market is well valued. We're not going to put that repricing in there. So they're using the exact same approach. What I like about this paper is even though it's very old, it's many years old, the theory behind it still works. So they go through each one of these, the dividend yield, stock repurchases, inflation, real earnings growth. They go through each one of them and they justify how they got the numbers. And they go through the exact same conversation I had on the earnings growth and tying it back to GDP. And you know, looking to the future, they're going back in this article and they're saying, how can we get these numbers for each one of these? Here's earnings, real earnings growth, just exactly like the chart I showed you, except for I've got more recent numbers like the 2008, which is pretty shocking. And here they showed, this is corporate profits, a percentage of GDP. Now I think this is just the S&P 500. That's why it's a lot lower. I gave you a number like 13 to 14%. They're showing it's much lower than that. But corporate profits percentage of GDP. And I think corporate profits has actually come up some here recently. But they're asking the question, why should corporate profits grow more slowly than our economy? And one of the big arguments they make is some of the fastest earnings growth over the next 10 years are going to be companies that don't exist right now. And so we're looking at the existing stock market and its growth, but there's going to be companies going out of business and new companies coming in, And that's the reason why corporate earnings growth for reported sectors, industries, and indices that we're using, that's why it can be slower than the overall economy and still stay at the same percentage of the economy over time. So it's just some really, really good discussions in here that are still applicable today, even though it's really, really quite dated in the analysis. So, all right, I'll leave it there. I'll stay on if you have any questions. But y'all see, paper 6 is not that bad. I've already written the whole paper for you. So all you got to do is come up with your own numbers. All right, that's it for tonight.